All right, here we are one last time. So this is officially our last meeting. And so we're pretty much done with all the new material. So I thought it might be a good idea to go back and revisit chapters 13 and 14, since the final exam is entirely based on those two chapters. It's not comprehensive. It doesn't go all the way back to day one. So keep in mind that it is due on Sunday night because they have a very strict deadline with the grades. And if I miss it, they'll give everyone Fs. So we have to keep an eye on that. So it should be ready by Sunday at midnight, along with whatever Excel spreadsheets you haven't finished yet. And also, of course, I just want to mention too that this week there aren't any actual WebAssign problems. You just have to do the final exam. Okay, so I did that on purpose so that you wouldn't be overwhelmed with work this weekend. So this way, instead of having one more set of assignments, you just have to do the final exam, which is based on derivatives only, which is good because it's a very interesting subject. And I also went through and made sure that the questions are what we've been covering. None of them are of any bizarre, exotic topics. It's all stuff that we've done. But it never hurts to go back and review some of the most important ideas. So let's go back to chapter 13 and start reminding ourselves the main differences between forward contracts and futures contracts. And of course, the word derivative, the name derivative securities, I should say, refers to the idea that the value of these securities depends entirely on the value of the underlying asset and other factors too, but they take their value from, or they are derived from, some underlying security or other variable. As we saw, the underlying doesn't necessarily have to be a traded security. It could be something like interest rates or anything else you could imagine. But they've been around for quite a while. Forwards and futures, as a matter of fact, forwards and futures have been around for quite a few years, hundreds really. But that's because they're very straightforward securities. They're really not that complicated. So it's options that are very complicated, and that's why they've only been trading in the United States since 1973. But even in the United States, futures have been around since the middle of the 19th century. It turns out that a lot of the activity in futures contracts got started in the Midwest because this is where, in Chicago in particular, this is where all the grain markets were. And so a lot of agricultural commodities were traded in Chicago, and it became clear fairly quickly that there was a demand for something that could help farmers hedge their price risk. And so the Chicago Mercantile Exchange is in Chicago rather than New York for that reason. It was established in the 19th century to facilitate the trade of these agricultural futures contracts because that's where the demand was. That's where the trading was taking place. The farmers were buying and selling with the customers, and so there was a clearly recognized need for hedging instruments, and that's where they came from. It wasn't until much later, the mid late 20th century rather, when suddenly financial futures and forwards became available. So if you look at all the ones that are trading on the CME, most of those didn't exist until the very late 70s. And so in a way, they're just as new as options. Okay, so in other words, previously, almost all the trading in these derivatives was with respect to agricultural commodities. And then, if I'm remembering correctly, the first financial futures contract came along in 1976. It was based on currencies. And then later on, they added interest rates. And then, pretty soon before you know it, you can get derivative securities based on almost anything you want. So anyway, what really is it that separates the two of them? Now, in the final exam, you'll notice that they will ask questions about the strategies for hedging. They may ask you about some of the terminology. Basically, for example, they might ask you about the difference between being long and short. And they'll certainly ask you questions about the differences between forwards and futures. And so we start by noting that among the many differences between forwards and futures, is where they trade. Okay, so the organized exchanges like the Chicago Mercantile Exchange are where we find futures contracts. And we looked at this once before. We saw it was quite an enormous list. Boy, they seem to have everything. So let's take a look at, oops, I think I should have been more specific here. Chicago Mercantile Exchange. Yeah, they're CME Group, I should have said. Okay. By the way, I'm not sure if I mentioned this, but if you look under the education tab, if you're really interested in learning more about derivatives, they have all these free educational materials available. They're actually classes that you can take. In fact, if I'm not mistaken, I think you can actually take exams and get credit for passing them. So you can see they have all kinds of them. And you probably are wondering, well, why are they doing this? And it's free, by the way. It's completely free. Anyone who's interested can come in here. And like here, for example, they've got 18 lessons based on futures contracts. Well, um, why are they doing this? Look at that, accredited course, the whole nine. See, start the course and you're all set. The reason why they're doing this is because, their business depends on volume. And so they're hoping that people who might potentially use these products in their jobs, let's say, the more education they have, the less scared they are of derivatives. And so they're more likely to go ahead and say, all right, let's call the CME and buy a futures contract. It's kind of like you may have been into a casino where they actually have classes going on where they actually set aside a small room somewhere, maybe in the basement somewhere, and they have an actual dealer sitting there teaching people how to play the different games. It's completely free, of course, but of course the whole point is they're hoping that you'll say, wow, now I understand blackjack. Let me run upstairs and lose all my money on blackjack. So here what they're hoping is that the more educated the public is about derivatives, the more likely they are to do business with the CME. But it's kind of nice of them to offer all of this. I mean, really. Um, it's completely free. And you would, if you do pass the test, you actually could put this on your resume, the fact that you have taken and passed these classes. Now they mention here CFA. CFA stands for Certified Financial Analyst. It's a credential you can get. Um, it's a very rigorous, intensive program where you basically take 3 standardized exams based on everything you could ever possibly know about finance that you would normally learn in, let's say, an MBA program. And it's tough. A lot of people don't pass it, but and GARP is a risk management organization. They have their own standardized exam, the FRM for Financial Risk Manager. It's a 2-part exam. I actually hold that credential, as a matter of fact. And so apparently these 2 organizations, while they'll hand out these credentials, they require their members to obtain a certain amount of additional education every year to maintain their certification. And so classes like this will make that possible. You can just take these classes and say, look, here's what I've been doing. I've been studying futures contracts in my own time. And that way you can fulfill the requirements. So there's, everything about this is good for everyone. Okay. And so, but it also gives you a chance to learn more specialized information. Oh God, where is it? Here we go. Some of it is much more specialized. Like if you think about you're actually going to get a job in this area, or like here's one. Pricing treasury securities is actually a very complicated thing because of the dates. The problem with calculating interest rate payments is that the year has a peculiar number of days. And so every market that involves, interest payments has its own way of calculating what are called day count conventions. And so it's not a simple thing to come up with the correct price for a treasury bill, for example. And until fairly recently, yeah, these quotes, you'll notice that there were several questions that I decided not to use because we didn't really go through this, but these quotes for treasuries actually are based on 30 seconds of a dollar. they still have this system. Stocks were using the system until relatively recently, but three means 3/32. Three plus means it's halfway between three and four, which means you're looking at 7/64ths of a dollar. It's kind of ridiculous that they never went to the decimal system, but that's how it's done, if you can believe it. I guess it's just because that's always how it was done. So, these are exactly the kind of things you'll find out on this website. So it's there if you want it, if you're interested. And, they'll talk about agricultural and like cattle, for example. But then, you get these very energy metals, but then you get these very sophisticated one, Mini 500. These are smaller versions of the S&P 500. We don't have to spend so much money. Anyway, but now it's getting to the point where they have the cryptos and all kinds of securities that are available. So I can actually buy a futures contract on Bitcoin if I want to, for example. Yes, it's gotten to that point. All right, anyway, so among the other many things that distinguishes forwards from futures is that forwards are only available in the so-called over-the-counter market, where you negotiate directly between counterparties. So if my business involves something that doesn't trade that heavily, like some very specialized metals that you don't see used very often, like let's say my specialty is nickel, I produce nickel. There aren't going to be any futures contracts on nickel at the CME because it's not traded as much as gold and silver and platinum. So what do I do to protect myself from price changes? I'll go to the over-the-counter market. I'll get in touch with a financial institution and say, listen, I need a forward contract rather on nickel, and then they'll tell me what the price is, and then we set it up. So that's how that's done. It's just a direct agreement between two counterparties. If I'm one of their best customers, let's say they'll do this for me because I'm a customer, but it's simply an agreement between me and the financial institution. Now, the unfortunate thing about that is that I'm locking myself into this contract. I can't turn around and sell it to somebody else like I could if it were a futures contract. Whereas we saw when we were discussing this earlier, rather than selling my contract to somebody else, I could simply offset it by taking the opposite position. Like, for example, if I have a long position in a futures contract, let's say to buy platinum in 6 months, let's say that's my business. Let's see, just as a quick reminder, forwards are traded or negotiated. I guess instead of saying traded, I should say negotiated between counterparties in the over-the-counter market. Futures are only available through organized exchanges. So now, there's a lot of good things and bad things about this. One of the good things about this is that it takes away all the credit risk because these are actually very heavily regulated. There's an organization called the Commodity Trading Futures Commission that oversees all this trading, and they're going to make sure that everything is on the up and up at the exchanges that are dealing in futures. Whereas with the over-the-counter market, you could end up getting into a contract with a counterparty that goes bankrupt, and then you're just out of luck. There's not a whole lot you can do about it. But futures forward contracts are not, let's say, highly illiquid. It would be difficult or even basically impossible to sell a forward contract. And it may not even be legal. It's possible that you couldn't even do this even if you wanted to. Or, because, once, let's say you've decided, I don't really need to do this after all, whatever exposure I was worried about has not materialized. I don't want this contract. You could in principle negotiate a buyout with the counterparty, but they're not obligated to help you out in that sense. So, with a futures contract, due to their high volume, they are extremely liquid. It's easy to sell them, easy. So you could sell a contract, but even it would probably be easier. An investor can offset a futures contract by taking the opposite position with the same asset and the same delivery date. So just as a quick example of this, for example, a company that routinely buys platinum for some reason can take a long long futures position to buy platinum, let's say, on September 1st. If the company changes its mind, it can take a short futures position to sell platinum on September 1st. So you technically have two contracts outstanding, but their cash flows exactly offset each other, which means that in effect you have no exposure to platinum. And so it's easy to arrange this in the futures market, not in the forward market. So the futures contracts give you more flexibility in the sense that you can get into or out of them quickly. But the unfortunate thing, though, is that futures contracts are completely standardized, which means they only have certain ones available. If you're and quantities too, I should say. Certain assets, quantities, and delivery dates are available. If they don't have what you want, well, then you're out of luck. Okay. For example, a British pound futures contract is written on 62,500 pounds. And if that's not convenient, well, then you probably should go to the forward and get a forward contract. The delivery dates are March. It's on a March, June, September, and December cycle. And even then, within that month, I believe it's the third Wednesday when the actual delivery would take place. So it's very restrictive, okay, to say the least. But because of that, that's why the volume of trading is so high in each contract. So that works against you and for you at the same time. Forward contracts are 100% flexible. The counterparties can negotiate the purchase or sale of any asset, any quantity of the asset, and any delivery date. Okay, so that's, in other words, if you need something a little off the beaten path, you want a forward contract most likely, because you won't be able to find it at the CME. It won't exist. If they don't have it, they just don't have it. Okay. So the forward contracts are more flexible when you set it up, but as far as getting out of position, futures contracts are much more flexible. All right, then we also know those are the derivatives over the counter market. Oh, one thing we don't want to forget about, I think they'll ask about this in the exam. The forward price of an asset is the price of future delivery. For example, if it is possible to enter into a forward contract to buy gold at 3,500 per ounce on, let's say, October 1st. Well, actually, no, it wouldn't be, it normally would be a fixed number of months in the future. It's usually 1, 3, 6, 12 months in the future, although anything is possible. But let's just say, to keep it simple, it's in 3 months, exactly 3 months from today. Then the 3-month, the forward 3-month forward price of gold is 3,500 per ounce. Okay. So in other words, that specifies how much you'll pay or receive if you're the seller for the gold in 3 months. Okay. So the spot price of an asset is the price that applies to immediate delivery. In other words, if I want to buy the gold right now, that's how much I'll pay for it. In fact, just out of curiosity, let's see how much gold is selling for today. I haven't looked at the news yet today. I'm guessing it's in that neighborhood, 3,500. 33, 38. Okay, that's fine. And if you notice, it trades on the COMEX, the commodity. I think it stands for Commodity Mercantiles Exchange. Hold on one second. So this is a spot market. It's not a derivatives market. Oh, it's part of the New York Mercantile Exchange. Okay. It focuses on trading metals, including gold, silver, copper, and aluminum. Okay, so it's because the Mercantile Exchange also does deal in derivatives. They also have, I think, energy derivatives. It's and yeah, as I mentioned before, this is all under the purview of the Commodity Futures Trading Commission. Now, wait a minute. Now, this is, oh, wait a minute. They're telling us two different things. Wow, now that's strange. Unless there's two COMEXs. See, now they're telling us it's part of the New York Mercantile. Well, oh, wait a minute. How is this possible? This is very strange. It's known as a COMEX, is the New York Mercantile Exchange, unless the CME owns the New York Mercantile Exchange. Well, we'll worry about that later. But yeah, I mean the Chicago Mercantile Exchange actually is a result of multiple mergers between other exchanges that don't really exist anymore. But anyway, so yes, so the forward price just simply means that's the price. If you're going to take future delivery, that's how much you'll pay for it at the time. Okay. Now with the futures price has the same idea. Is the price at which it will be delivered at the maturity date of the contract. So it's the same basic idea. Okay. And another thing I just want to quickly remind everyone, a long position means that the investor is going to buy an asset in the future And of course, a short position means that the investor is going to sell an asset in the future. And of course, in order for there to be a long position, there has to be a corresponding short position. You can't have one without the other. Now, what's interesting is that with the futures contracts, the exchange acts as a middleman and matches up long positions with short positions. In other words, if I'm buying, I go to the CME and I say, I need to buy, platinum in September, they're going to have to go out and find somebody else out there who wants to sell it. And then behind the scenes, without my knowing about it, they've hooked me up with a seller who might be some metals dealer. And so when I buy, they deliver. I never see this side of it. The CME takes care of everything. So it's because nobody necessarily wants to be known to the counterparties. Whereas with the forward contract, of course, you know who you're dealing with. Now, of course, the beauty here is that if the counterparty fails to, satisfy their obligations, the CME will step in and take care of it. But they will find a way to get the money out of the counterparty. But they're the ones who will cover whatever problems there are. All right. So yeah, this is our discussion about exchange rates. The purpose of hedging is to simply lock in a price at which you can buy or sell. It's the opposite of speculation, of course. Let's see. So hedging, the reason why these contracts exist in the first place is to make it easier to hedge risk. But of course, a lot of people use them to speculate as well. Hedging simply means reducing or eliminating the risk. Speculation is just the opposite, means taking a risky position in the hopes of earning profits. So you're doing the exact opposite of a hedger. And so, of course, in a normal financial market, there's going to be some of each. A market couldn't really survive without both. I mean, because the hedgers they're trying to get rid of their risk. They're more likely to be buying, let's say, in the hope of avoiding future price increases. But the speculators actually provide a lot of liquidity to that market, so they need to be there too. They're not like villains or anything. They are providing a lot of liquidity in this market. Without them, it might not be possible to have this market in the first place. Now, of course, another thing maybe I skipped over it. One of the major differences between forward and futures contracts is that futures contracts are marked to market, while forward contracts are not. All right, so remember how that works. This means that investors who take a position in a futures contract must put up funds into a margin account. These funds act as a form of collateral. So the amount required is usually a very small percentage of the total value of a futures contract. In other words, like, with the British pound, for example, if the exchange rate between the dollar and the pound let's say to keep it simple, is $1.30 a pound. And we know that the contract is written on 62,500 pounds. The total value of the pounds underlying this contract is, well, you can imagine it's going to be in the neighborhood of $100,000. Let's see. Oh no. Oh, okay. It's a little shy. 81,250. The margin requirement for this account could be as little as, let's say, $3,000. Which is a very small percentage. I mean, that's like, 3.7%. All right. So, and the purpose of this is, so here's what's happening. The logic here is that if you have a bad day in the markets, I mean, at the end of each day, let's put it this way, there is a settlement committee at the exchange that determines the final trading price for each contract. So in other words, the day ends and gold trades throughout the world, but they're going to say, listen, at the end of the day, here it is. It's closing time in Chicago. The final price for today is X dollars, and that's how they decide whether or not your margin account has gained or lost money. So this final price is actually called the settlement price. And is used to determine how much each margin account is worth. If you made money, they'll put money in your account. If you lost money, they'll take it out, of course. But the point of it is that if an investor's losses are sufficiently large during a given trading day, they may be required to deposit more funds into the margin account. This is known as a margin call. If the investor can't put up the money, the position is closed out. That's it. You get one day. That's it. There's no fooling around. If they call you up and say, listen, you have to put $10,000 into your account, and you say, sorry, I don't have it. That's it. The position gets wiped out. The counterparty will be matched up with somebody else, and they will deal with you later. Okay. So in other words, the size of the margin requirement is the exchange's estimate of how much could be reasonably lost during a given trading day, because that's really how much risk they're exposed to. With this system, this is how much risk they're exposed to. They can't stop. I mean, they can't just shut down your account during the middle of a trading day. But when the day's over, like, listen, fine, you lost money. Don't worry about it. Give us some more margin, and we're all set. If you can't handle that, that's it. You can't lose any more money if they close out your account. And since they're responsible for those losses, then they don't want this to go on more than a day. And I think I mentioned this in the sad story about Barings Bank. This is how Nicholas Leeson ultimately was caught, because he couldn't cover the margin requirements. They were really huge. I mean, like, oh, hundreds of thousands of dollars. It was some preposterous amount of money that he was losing and losing and losing. And it was just like he just kept getting in deeper and deeper and deeper. And he just couldn't get the money together. And so the exchange closed him down. And that's when it came to light how much money he'd really lost. I mean, he'd been essentially lying to his employers all that time because they foolishly put him in charge of both trading and reporting. And so bad combination. So anyway, so as far as so that's one of the really big differences between futures and forwards is that margin requirement. Now, here's some good news though. From the investor's perspective, the margin requirement can be satisfied with treasury securities. It doesn't have to be cash. That means if I have a treasury bill worth the amount that they're asking for, I can just use that as collateral. Why does that help? Because that means I'm still earning interest while my money is tied up in this margin account. So this way, investors can continue to earn interest on their margin accounts. Okay, that's a huge deal. I mean, you're otherwise there's a huge opportunity cost to holding money in a margin account. All right, let's see what else differs between these two. Well, the whole logic behind hedging in the first place is the same for options and futures. I mean, not for forwards and futures. So, oh yeah, the delivery. Yeah, I just want to remind everyone about that. So, because it is easy to take an offsetting position in a futures contract. Studies have shown that only something like 2% of all futures contracts result in actual delivery of the underlying asset. Most investors who are hedging with a futures contract are not interested in taking actual possession of the asset. They are simply hedging, trying to earn profits from their contract if they lose money in the spot market. So in other words, for example, a jewelry manufacturer will buy 10 ounces of gold on September 1st. The futures price is currently, let's say, $3,500. Okay, so by entering into a long futures position, if the price of gold rises by, let's say, $100, the firm will have to pay $3,600 per ounce in the spot market, but will receive a profit of $100 per ounce from their futures contract, so that the net effect is that their cost of buying gold is 3,500. So you're actually going into the market and buying the gold for the market price or spot price, but you get a profit from your contract. Okay. So you can just close out this account and collect your profits, or else you can use the contract to actually buy the gold at $3,500. So either way, you're going to end up still being able to buy the gold for 3,500. But if you get out of the position, you're going to collect your profits and then use that to pay for the higher expense of the gold. So with a forward contract, the contract itself is what you're going to use to buy the gold, because that's what you're obligated to do. The investor will actually take delivery of gold at the forward price at the maturity of the contract. Okay, so these are the key differences. And so which one should we use? Well, it depends on a lot of things. Like, do you really want to buy or to sell the asset? Is what you need available on the Chicago Mercantile Exchange or other exchanges? Are you willing to put up money into a margin account, or is that going to be a hardship? There's all kinds of possibilities, but they're both thriving markets. There's a lot of interest in both of them. There's a lot of transactions volumes. So that shows that there's a huge demand for both products. In spite of their similarities, they're distinct enough that some people will use one and some will use the other. All right, now that leaves us with options. Now, options are, of course, the most complicated of all the derivatives. They're also the most powerful and they're most flexible. And they're also the ones that require a lot of rocket science to price them properly. So in other words, futures and forwards are incredibly simple instruments. Pricing them is a breeze. That's why they've been around for so long. There's no mystery about how they're priced. But options, it was a very thorny problem that occupied humanity for many years, because there have been times in the past when options were actually used, but they're very poorly understood. And so it was possible. It was always possible to make these arrangements. But in fact, there's this interesting story. I wonder if I can find it here about options in ancient Greece. No, maybe I'm thinking of the wrong Greek. Oh, I wish I could remember the man's name. No, all right. I don't want to waste your time here, but oh wait, it was Thel. Oh my God. All right, here we go. So here we go. It's ancient Greece. And so the philosopher Thales, oh my God, what happened? Here we go. 600 BC. He was an aspiring philosopher, but he was mocked for his useless writings and poverty. Apparently, people would tease him about, because he really lived in very simple circumstances. He was just like living in a hut, and apparently people said to him things like, well, if you're so smart, how come you're not rich too? So he thought of a brilliant idea for making himself a lot of money. And so at that point in time, of course, the main crop in that area of Greece was olives and, producing olive oil. But in order to do that, you not only had to have the land to grow the olives, but you had to have olive presses to turn it into the actual oil. And so apparently in those days it was possible, or at least he came up with this ingenious idea, He went around to all of the owners of all the olive presses and he set up an option to use the presses uh, before anyone else. In other words, he said, listen, I'm going to negotiate a contract with you where in exchange for X dollars, I'm the one who gets to decide if I should use this press or not. So basically what he did was he built up what amounted to a monopoly in the olive presses by buying options on every single one of these presses that was available anywhere near the town they lived in. And so when the harvest came, all these producers realized, wait a minute, we can't press these olives. We don't have the rights. We have to get them from Thales. So, well, let's just say he charged them a very, very reasonable price to use his options to produce the oil. And let's just say he made rather a nice little killing there. So that way he could take all of this money and go back to living in the woods and writing philosophy all day. But he showed everyone that he was smart enough to make money if he wanted to. Okay. Now, at this time, the concept of an option, nobody really, I guess, it wasn't a common thing. And so he came up with this brilliant idea just to show people. He wasn't really interested in money. He just wanted to show everybody that he could do this if he really felt so inclined. I mean, he's basically saying, I'm above all that. Money, who cares about money? But I could do it if I wanted to. And so this is how he proved to the world that he could make money if he wanted to. Yeah. So that's it's one of these fun. I don't know. Whenever you read about these stories, you don't know how much of it is really true. But I've seen this enough times that there seems to be some basis in reality that I would say that something like this really did happen. But this, yeah, it's kind of interesting. Oh, I didn't see that part. He wasn't just a philosopher; he was a mathematician as well. Um, According to Aristotle, he was the father of geometry. But in those days, the Greeks considered geometry to be part of, philosophy, and it was just all interrelated to each other. So there they are, the olives are being processed. So anyway, I thought you'd find that interesting. So anyway, what is different about options then? So options are far more complex derivative securities. The lack of pricing models prevented wide-scale adoption of options in the US and the rest of the world for that matter until 1973 when the Black-Scholes model was first published. And that really kind of blew the roof off of the whole market because even though the Black-Scholes model was very specialized, the Black-Scholes model, as it first came out, only showed how to price European call options on non-dividend paying stocks. That's it. That's all it was meant to do. Now, these guys, Black and Scholes and Merton, were academics. I mean, yeah, of course, they made a bundle of money in consulting, of course, like all business professors, but they were doing this because of the academic interest. Later on, they even said, listen, we had no idea how important this would prove to be. But now, once the model was in place, and they really revolutionized the whole field of derivatives pricing, they incorporated a brand new, relatively new branch of mathematics called Ito calculus in order to do this. And luckily, in the next few years, research papers by Black, Merton, and Scholes showed how to expand or extend the Black-Scholes model to price virtually any European option, not just calls, not, and so in other words, and then that only took a few years. All of a sudden, this sort of triggered an explosion of research. And so Merton did a lot of this research. In fact, he was the one who introduced them to the Ito calculus. And so it was because it was based on this very flexible mathematical framework, it became possible to extend it and say, well, here's how you do it with puts, here's how you would do it with stocks that pay dividends, here's how you could apply it to currencies. And so within just a few years, it was very, very much more powerful. American options required a much more sophisticated framework. But the first papers that showed how to price American options based their models on the Black-Scholes model. In other words, it kept the same assumptions as Black-Scholes about the properties of options, but they showed how you could take what they essentially did was create what amounts to a tree where you can show as you move along through time how the option prices evolve. And because of the way it was set up, it became possible to test at every point in time whether the option should be exercised early or not. Because remember, that's what really separates American from European options. European options can only be exercised on the maturity date. Well, American options can be exercised anytime during the lifetime of the option. But that means that every day that goes by, you have to make a decision. Should I exercise it early or not? And so that's where the complexity comes from. Like, how do you know? Like, well, should I let it survive another day or should I exercise it? So, but all this happened within a very short period of time. I mean, all these papers came out, and by the late 70s, then suddenly all these new options are being created. And the derivatives market really, really took off at that time. So it's because of these. And by the way, they did eventually win the Nobel Prize in economics because it was that important. It was like, you could compare it almost with like Einstein's papers in the early 20th century, where he wrote about, relativity and all these important concepts. And he did also win the Nobel Prize in physics, by the way. So it's in the same level of importance within each discipline. So now, of course, the volume of trading in options is through the roof. Now, by the way, here's a fun side note. Another story, not fail anymore, but this is kind of interesting how the American economist Paul Samuelson, a Nobel Prize winner himself, discovered that in the early 20th century, a PhD student at the Sorbonne in Paris, Louis Baclier, discovered a great deal of the math that was used in the Black-Scholes paper. Unfortunately, his dissertation, and this was for his doctoral dissertation. Unfortunately, his work was written in French. Well, I mean, you would expect that in France, of course, but and was not translated into English until many decades later, after he'd already died, of course. So, in other words, Samuelson announced to the world, listen, well, this Black-Scholes paper is wonderful, but guess what? Louis Bachelard discovered a lot of this, what they wrote about 70 years ago, and nobody knew anything about it. But now we do. So it's too late for Louis, but we now know that Louis Bachelard was one of the important discoverers, I guess, of what is now known as modern option pricing theory. So you just don't know. The history of these scientific discoveries is quite interesting. But anyway, options are characterized by the underlying asset, which doesn't have to be an asset. It could be like interest rates are not an actual asset. It could be literally anything. The underlying asset, the strike price, which is the price at which the asset can be bought or sold. The maturity, or I should say probably time until maturity is more meaningful. And whether, oh, and yes, call or a put, which means remember the call you can buy and the put you can sell, and whether the option is European or American. Okay, just as a reminder, the call option gives the right to buy and the put gives the right to sell. That's it. If you know all that, you know everything you need to know about that option. So the price. Now, one of the big differences between options and forwards and futures is that the option requires the investor to pay a premium or price. And that's what the Black-Scholes model is trying to determine, by the way. That number, that price that you pay for the option depends on a lot of features. This price depends on several factors, such as the price of the underlying asset, the strike price of the option, the time to maturity, the risk-free rate of interest, which is the yield on treasuries, which means the yield on a treasury security with the same maturity as the option, and the asset's volatility, as it's called. This is a statistical measure of how much the price fluctuates over time. Those are all the factors that determine the price, at least of a European option. And that's what the Black-Scholes model is using to price it. So that's one of the key differences. Another major difference is that with options, the investor is never obligated to follow through and buy or sell the underlying asset. Okay, so in other words, that's really the biggest difference, I think, because you can enter into an option to buy gold, and when the day arrives, you can say, "Nah, never mind, I don't want it." You can't do that with a forward or a futures. With the futures, you have to go through the formality of offsetting it. With a forward contract, you have to take the delivery of the gold. You agreed to that. The option means no, I don't have to. But that's what you're paying for. You're paying for the right to do something, like Thales and the option to use the olive presses. He could have, I mean, eventually he sold that right to all these different producers at a very lucrative price, but he could have just said, no, that's it. I'm going to hang on to these. And nobody would have had any olive oil that year because he's the only one who had the right to press the olives. So instead, he sold it to these people for very nice profit. Well, anyway, so options have limited the owner, I should say, the buyer of an option, not the seller, has limited loss potential and unlimited profit potential. So then we introduce the idea of payoffs. Recall that's max S minus X and 0. For a put, it was the max of, it's the opposite. And then, but these are the buyers, by the way. I should have specified that. For sellers, it's just it's the negative. Okay, and then we have the profits. And again, we have to specify for the buyers, they pay the premium. Oops. So the only difference here is it's the payoff minus the call price, which we'll call C. And for the put, and then for the sellers, they're the ones who collect the premium. Oops, I almost forgot the negative. Okay, so those are the basic positions, and we've seen how the graphs work. Okay. And then what we did was we went ahead and we looked at some basic option strategies that we can carry out with these 4 basic positions. I also want to mention here that calls can be used to hedge the risk of rising prices and speculate on rising prices. In other words, you're betting on rising prices. Puts can be used to hedge the risk of falling prices and speculate. In other words, you'll make money. If you buy an option and the price goes up, even if you don't really want to buy that asset, you'll still make money from your option. Okay. And by the way, I do want to mention too that if you don't exercise it, you still always have the right to sell it to somebody else. And that's how you could collect your profits without actually taking delivery of the asset. So puts can be used to hedge the risk of falling prices and speculate on falling prices. Either way, you'll make money, whether you're the seller or the speculator. That's what they're for, okay? And then, of course, we saw that, there's all these wonderful strategies we could employ. So there are many, and I mean many, different strategies that can be created from options that would be impossible to replicate with other securities. And we saw a few of them. We will just put the categories. Remember, we had spreads, which is two or more calls or puts that differ in at least one way. For example, the strike price, the asset, underlying asset, or the maturity date. Usually, usually it's the strike price that's different. And then we have combinations, at least one call and one put. And then that's all you have to specify because they can be literally identical to each other in every way. So, and then there are also, I don't know if there's a separate name for them, but some strategies involve, as we saw, combining a position in an asset with an option on that asset. All right, we did see a few of these too. So now somewhere along the way, I don't know what happened to it. I have this document that I found online somewhere, which actually contains even more of these strategies. Let me quickly see if I can find it in my archives here. You might find it interesting, just to get a sense of what other types of strategies are possible. Hmm. Yeah, it's just sometimes it's just unbelievable how maybe I think that's it. Oh my God, I think I went right past it. Okay, what I'm gonna do here, just in case you're interested, first I'm gonna go pop it into black bright space rather. And then I'll show you why it's so exciting to have this thing. And one of the reasons that you might want to have it even now while you're working on the final exam is because it has a nice summary of some of the basic positions, but it also shows you some of the more really bizarre ones. Oops. Here we go. All right, so I'm going to sneak this in here, and we'll take a look at it. All right, here we go. Now, this is published by an organization that is set up to increase education in options, called the Options Industry Council, to promote, the use of options. And so they've got all this terminology to remind you what these key terms mean. And they're showing you how they'll illustrate these strategies. They're always going to show you the strike price and the break-even point. They're going to also explain to you when you might want to use these strategies. So here's an example. We've seen this one, the long call. You buy a call, and we saw this already. It's bullish, meaning that you buy a call because you're optimistic about the future direction of the market. The risk is limited. You can see there's a maximum loss here. The reward is unlimited. This arrow can go on forever. Volatility, if volatility goes up, that helps your position, as we discussed the other day. But the passage of time hurts your position because the premium that you pay for the time is going to shrink. And the break-even point is the strike plus whatever you paid for the option. So you can see they're all going to be analyzed like this. Now, this is the bull spread that we set up. It's a bull call spread. We buy the low strike call. We sell the high strike call here. And risk and reward are both limited. And time erosion depends. So this one is, and this is the same thing with puts. We saw this one too, covered call, where you just own the stock and you sell a call against it. The risk is somewhat limited. Protected put, we saw this one too. You own the stock and you also buy a put, which puts a cap on your losses. And then, we've got some others. Now we're the long put, which means you're bearish. You're expecting the price to go down. The bear spread, which is the reverse of the bull spread, which means you're selling at the high strike and buying at the low strike. The collar. Now, we didn't talk about this. You own the stock, you buy a put, and you sell a call with a higher strike. And you can see it looks a lot like the bull spread. Why would you choose one or the other? It might be cheaper. Depends on the prices of the options that you're using. A straddle, remember we talked about a straddle. If you buy the straddle, you're betting on volatility. If you're selling the straddle, you're betting against volatility. But you can see the risk is unlimited. Oh, that's scary territory. Short strangle, the reverse of the one we saw, where it's a straddle but with two different strike prices. Iron condor. Now this is a wacky looking one. It's like reverse strangle, except that there's a cap on your losses. So now look at this one. Now this one is different because the two options that we're buying, or actually we're selling one and buying one, they have different expiration dates. That's the first time we've seen this. So you can see that you're hoping that the price stays here in the center, but there's a cap on your potential losses. Now here's a wacky one. Covered strangle. You own the stock, you sell a call, you sell a put. Wow. So there's a cap. See, here's the unfortunate thing. There's a cap to your potential profits, but no limit on your potential losses. Wow. There's our friend, the butterfly spread. And oh, no, there's a few more. Straddle, remember we'd set this up with you buy the call, you buy the put. Very expensive, but you benefit from volatility. Strangle, same thing, except with two different strike prices. Wow, now we're getting some weird territory. The call back spread. You're just trying to stay away from this little area here. You're selling one call and you're buying two more calls at the higher strike. The put back spread, the same thing but with puts. And I believe that's it for the. So it's a very helpful little guide, I think. You can easily see what the purpose of these strategies is, how they're set up, in case you forgot, and understand why we use them. All right. So, I believe we're done reviewing here. So I think that should take care of everything. So like I said, the exam is the only last piece of business, which is due on Sunday night at 11:59 p.m. If you haven't finished all the Excel spreadsheets, make sure you get them in by that same time. And hopefully you finished all of the MindTap assignments as well, although I think you have. And then we'll be done. And so I'll be posting the grades probably on Monday because I think they're due on Tuesday, but I don't want to push my luck. I'll have them out there on Monday, and then we're done for the summer. All right. So I hope you had a good experience with this class. I hope you learned a lot, and it inspires you to take more finance classes. So I'm going to wish you all a good night then.
Thank you, you too.
All right. Good night.